Chapter 3, Valuation of Securities. In this chapter, we'll learn to value various securities like the bonds, the preference shares, the equity share capital. Okay, so first of all, the basic valuation model. This is the present value approach. First is basic valuation model. The present value approach that we've just done, that we've already seen in chapter number 2. So we're not going to go into detail of this thing because as we just covered it, the present value approach. Second is bond valuation. Now, bond is a long-term debt instrument or a security. In case of bonds, the rate of interest is fixed in advance and is known to the investors. The rate of interest is known as coupon rate in case of bonds. Bonds can be of two types. There can be a redeemable bond or there can be an irredeemable bond. So let's write it down first. Bond is a long-term debt instrument or security. In case of bonds, rate of interest is fixed in advance and known to investors. This rate of interest is known as coupon rate. A bond can be a redeemable bond and a irredeemable bond. Bond can be of two types. Redeemable bond or irredeemable bond. Now, redeemable bond is one whose life is fixed and it will be redeemed after a fixed period of maturity, which ranges from 5 years to 20 years. The redeemable bond is one in which life is fixed, bond is redeemed after fixed period, and the maturity ranges between 5 to 20 years. Irredeemable bond is a bond which is not to be redeemed. Bond which will not be redeemed. Now in questions we will be asked to calculate the fair value or the present value of the bond. Okay, so in case of irredeemable bond, first we are looking at as irredeemable bond. In case of irredeemable bond, the current price of bond is calculated as present value of interest over the infinite period. The current price of bond is calculated as present value of interest over infinite period. That is annual interest divided by required rate of return, that is KE, annual interest, and this is to be divided by the required rate of return. That is KE. This was in case of a irredeemable bond. The fair value of a redeemable bond is 14. In case of redeemable bond, we find the fair value as annual interest into sum of PVF. PVF is present value factors at required rate of return. Required rate of return for n period, that is the desired period, the number of periods given in the question, plus redemption value into present value factor for the nth period. This is how we'll calculate the value of bond, fair value of bond, in case the bond is a redeemable one. Let's look up at an example. It says find the present value or current price of the bond. Find present value or current price of bond. The details are as follows. The face value of bond is rupees 1000. Face value of bond is equal to rupees 1000. Required return is 12% per annum. Return is 12% per annum. Just remember that in case this per annum is not mentioned in the exam, this return is always mentioned at a per annum basis. Unless anything else is mentioned like half yearly or quarterly, this is always assumed to be per annum. Annual interest is 10% per annum. Time to maturity is 5 years. And redemption value is rupees 1200. Okay, first of all you need to identify that this is a redeemable bond. That is, the redemption value is given in the question, time to maturity is given in the question, so this is a redeemable bond. Now how do you must have been getting confused looking at these two rates. The first is the required return and second is the annual interest. This required return is the return desired by the investors at the investment, and annual interest is the rate of interest the company is paying on the bond. The interest is always paid on the face value. So let's calculate the current price by the formula that we just noted down. Current price is equal to, this is the formula, okay? Let's write down the formula first. Annual interest into sum of PVF at required rate of return for n period, plus redeemable value into present value factor for nth period. So annual interest is 10% per annum on the face value of bond, 1000. So 10% of 1000 is rupees 100. That is, company will be paying an interest of 100 into sum of PVF at the required rate of return for n period. This is present value factor, required rate of return. This is 12%. Okay, and N period is time to maturity, that is 5 years. What we have to calculate here is sum of PVF at 12% for 5 years. What is the redemption value is 1200 and present value factor for the 5th year. Sum of PVF at 12% for 5 years. Let's calculate this first. Same way that we had calculated for 10%. 1 divided by 1.12 equal to memory plus first year, second, third, fourth and 5th year. For the 5th year, we have present value factor as 5.674. No, 0.5. This is 0.5674. Memory recall. This is the present value factor at the rate of 12% for 5 years. 3.6048. So 100 into 3.6048 plus redemption value is 1200 and present value factor for the 5th year we just calculated as 0.5674. Let's multiply these components. This is, okay, you can see this 100 multiplied by 3.6048, 360.48, 360.48 memory plus and 1200, that is the redemption value, into present value factor for another year 0.5674. This is equal to 680.88 memory plus and memory equal to, this is rupees 1041.36. So we just calculated the present value or the current price of a bond in case this is a redeemable bond. Second thing that comes under this bond valuation is calculation of yield to maturity, that is YTM. This is under bond valuation itself, calculation of yield to maturity. Yield to maturity is the yield, that is the return that an investor gets if he holds the bond till maturity. So YTM. Yield to maturity is the return the investor gets if he holds the bond till maturity. The first method for calculating this is method 1. The first method that we are doing is used in case of irredeemable bonds. In case of irredeemable bonds, this is current yield is equal to coupon rate per year divided by current market price. Coupon rate is interest. Second method we have is linear interpolation method. this method is similar to IRR. There are 3 steps in this method. Step 1 is calculation of approximate YTM. Calculation of approximate YTM. The formula for that is annual interest plus redeemable value minus market price divided by life, and the whole thing is to be divided by redeemable value plus market price divided by 2. Now this formula will provide an approximate yield to maturity. Provide approximate yield to maturity. Now what we'll do is take 2 rates. Now take 2 rates, one above the approximate YTM and one below the approximate YTM. Now comes the step 2. In case of step 2, we'll calculate the NPV at lower rate and the NPV at higher rate. The lower rate and the higher rate are the 2 rates that we have taken here, one above the approximate YTM and one below the approximate YTM. Step 2. This is calculate NPV at lower rate and calculate NPV at higher rate. And step 3 is calculation of YTM. For that again we have a formula. The formula is lower rate. This is the formula of IRR. Lower rate plus NPV at lower rate. NPV is net present value. This is to be divided by NPV at lower rate minus NPV at higher rate into difference in rates. You will understand these formulas once we will do a question on this. Now I have written 14 on 2 pages. This is page number 15. Let's take up an example to understand this. Face value is rupees 100. Face value is equal to rupees 100. Current market price is rupees 95. Redeemable value is rupees 100. That is, the bond is redeemable at par. Annual interest rate is 13% per annum. Annual interest rate is equal to 13%. Time to maturity is 6 years. Maturity is equal to 6 years. So in the first step we had talked about the calculation of approximate yield to maturity. We'll strictly go about the formula that we did on the last page. Step 1 is calculation of, this is calculate YTM. Step 1 is calculate approximate yield to maturity. So for that we had written the formula on the last page. The formula was annual interest plus redeemable value minus market price divided by life, the whole thing divided by redeemable value plus market price divided by 2. So we'll replace these values given in the question. Annual interest rate is 13%. So an interest rate of 13% on face value of rupees 100 comes out to be rupees 13. 13 plus redeemable value 100 minus market price 95 divided by life. Life is 6 years. The whole thing is to be divided by redeemable value 100 plus market price 95 divided by 2 into 100. So let's calculate the approximate yield to maturity. So this comes out to be 14.185%. So in step 2, this was the step 2, calculate NPV at lower rate and calculate NPV at higher rate. Okay, now take two rates, one above the approximate yield to maturity and one below the approximate yield to maturity. Now this is approximate yield to maturity 14.185. Now step 2 is assume lower rate to be 14%, that is below this yield to maturity, and assume higher rate to be 15%, that is above this yield to maturity. Now what we have to calculate is, we have to calculate the net present value at 14% and net present value at 15%. First of all, NPV at 14%. We've written down a formula. So we can calculate this as annual interest 13 into sum of PVF at 14% for 6 years, which comes out to be 3.889 plus redeemable value is 100 into present value factor at the rate of 14% for 6th year, that is 0.456 minus the current market price, that is 95. This comes out to be 13 into 3.889, 50.557, 50.557 plus 100 into 0.456, 45.6 minus 95. So this is NPV plus 50.557 minus 95, 1.157. NPV at 14% comes out to be 1.157, coming to NPV at 15%. Same way, so this present value factor will be sum of present value factor at 15% for how many years? For 6 years. Interest will remain the same, 13 into the present value factor. This comes out to be 3.784 plus 100 is the redeemable value into 0.432. This is the present value factor at the rate of 15% for 6th year minus 95. Shall I show you once more how to calculate this? This is 1 divided by 1.15 equal to for first year memory plus second, third, fourth, fifth, sixth and memory recall. This is 3.784, 3.784, and again for 6th year is 0.432. 13 into 3.784 is 49.192, 49.192 plus 100 into 0.432 is 43.2 minus 95. 49.192 minus 95. This is negative of 2.608. Step 3 is calculation of yield to maturity. Step 3. Calculation of yield to maturity. This was the formula, you remember, lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into difference in rates. We'll directly place the values. How much is the annual interest? Lower rate. Lower rate we are taken at 14. The NPV at lower rate is, here it is, 1.157 divided by NPV at lower rate minus the NPV at higher rate, which was a negative of 2.608. 2.608 into difference in rates, that is difference between 15 and 14, which comes out to be 1. Now you have to calculate this component. This is 1.157 plus 2.608, 3.765. 1.157 is to be divided by this component and plus 14. It comes out to be 14.308 is equal to 14.308%. The yield to maturity is 14.308%. This was all about the valuation of bonds and calculation of yield to maturity. Coming to the second component under this chapter is valuation of preference shares. So we are done with topic 1. Coming to topic 2 is valuation of preference shares. Now preference shares are those who get preference over the equity shareholders. Their dividends are specified and they are paid before any amount is paid to the equity shareholders. So preference shares shareholders are those who get preference over equity shareholders, Their dividends are specified. And paid before equity shares. Now, how to calculate the valuation of preference shares? We'll write down the formula first. Formula is P0 is equal to D divided by KE. P0 means value today. 0 means today. Is value today. D is dividend. And KE is the required return of the investor. Required return of investor. Let's look up at an example. It says preference share pays dividend rupees 5.25, par value is rupees 100 and KE is 9%. What you have to do is calculate the price at today, price, that is P0. Simple, we'll apply the formula. D divided by KE, dividend is 5.25 divided by KE is 9, that is 0.09 is equal to 5.25 divided by 0.09 is equal to 58.33 rupees 58.33. Now yield to maturity or yield to call can be calculated using the same formula worded in bond valuation. Instead of annual interest, you just have to replace it with dividend. So this was about the valuation of preference shares. Moving to the third topic that we have is valuation of equity shares under valuation of securities. Valuation of equity shares. Equity shareholders are the ultimate owners of any business. Unlike preference shareholders, their return is not fixed, so it becomes difficult to value the equity shares. There are various approaches of valuing equity shares. Who are equity shareholders? They are the ultimate owners of the business. Equity shareholders, they are the ultimate owners of any business. The approaches for valuing equity shares are, one is DCM and another is ECM. DCM and ECM. DCM is dividend capitalization method. This is used for valuing small lot of shares. And ECM is earning capitalization method, which is used for valuing the big lot of shares. Let's look at these one by one. First is dividend capitalization method. Dividend capitalization method, that is DCM. In case of dividend capitalization method, simple present value approach is followed. That is, current or present price of equity share is equal to dividends received by it in the foreseeable future. In case of DCM, the current or present price of equity share is equal to the dividends received by it in the foreseeable future. Now, the formula for calculating current price when growth rate becomes constant is P0 is equal to D1 upon KE minus G. You'll understand this when we'll do an example on it. Let's look up at an example. Example is, a company pays dividend ₹2. A company pays dividend ₹2. It is expected to grow. It is expected to grow at the rate of 20% for 4 years. The normal growth rate after that period is expected at 5%. Required rate of return is 12%. Find out the price at present. First of all, what we'll do in this case is we'll identify the cash flows. Says the company pays dividend rupees 2. It is expected to grow at 20% for 4 years. So first of all, we'll calculate the cash flows, that is the dividend that we'll be receiving for a period of 4 years, and we'll calculate the value at 4th year end, that is the total value. Here the growth rate has become constant. In that case, for finding the dividend received by it for the foreseeable future, it can be calculated by using this formula. Okay. So let's identify cash flows. The question says a company pays dividend rupees 2 and it is expected to grow at 20% for 4 years. For year 1, the dividend it will receive is 2 rupees 2 plus a growth of 20%. How much it is? This comes out to be 2.4. At year 2, the dividend the shareholder will receive is 2.4 into 1 plus 0.20. 0.20 is the 20%. This 20% is the growth rate that is mentioned in the question. This is 2.88. Year 3, 2.88, 1 plus 0.20, 3.456, and at year 4, 3.456, 1 plus 0.20 is equal to 4.1472. Now after this, the growth rate becomes constant. That is, we'll continue to receive dividend for the foreseeable future. We'll calculate the present value of all the dividends we are going to receive in the future using the formula that we wrote on the last page. What was that? P0 is equal to D1 upon KE minus G. This is P0 is the present value today, and what we are calculating here is the present value of all the dividends that we are going to receive in the future from this share. So D1 in this case, what will be D1? The dividend at year 4, 4.1472, and the growth rate in this dividend, the growth rate is going to be expected to be at 5%. It was mentioned in the question. This is 0.05 divided by KE. KE is the rate of return which was given in the question as 12%, 0.12 minus, and growth rate is 0.05. Let's calculate this. This is 4.1472 into 1.05 divided by 0.07, 62.208 rupees, 62.208. Now we'll calculate the present value at 12%. What is 12%? 12% is the rate of return desired by the investor. So let's calculate the present value. Calculation of present value. Year 1, 2, 3 and 4 cash flows. In year 1, it will receive a dividend of 2.4, year 2 2.88, year 3 3.456, and year 4 4.1472. This is the dividend it will receive. Along with the dividend, we also calculated the present value of the future dividends that we are going to receive, which was 62.208. Here it is. I've taken it from here. will discount these cash flows at 12%. That this is the required rate of return. So present value factors for 12%, 1 divided by 1.12, 0.893, 0.893 for year 1, second 0.797, 0.797 for third, 0.712, 0.712 for fourth, 0.635, and this is also fourth year, so present value factor for the fourth year. Calculate the present value by multiplying the cash flows with the present value factors at 12%. So 2.4 into 0.893, 2.1432 memory plus 2.88 into 0.793, 2.28384. This is, I think, let me calculate, 1 divided by 1.121. This is 797. 0.797 into 2.88, 2.2954, and you can calculate the rest like this. This is going to be 2.4607, 2.6335 and 39.5021, and add this up, you will get the present value, which comes out to be 49.0349 in our case. So this is the present value. So we just completed the dividend capitalization method. Now we'll move on to the second method in equity valuation, is earning capitalization method. This is earning capitalization method, or ECM. Earning capitalization method, ECM. The formula for this is ECM is equal to earning rate divided by normal rate into paid up value of share. The questions have not been asked on this part, so let's not do a illustration on it. Various other approaches for equity valuation are book value approach and the liquidation value. Book value and liquidation value. First is the book value approach. In this case, we'll calculate the book value per share. Book value per share is calculated as equity share capital, that is paid up equity share capital. In this, we'll add the reserves and surplus. So adding the reserves and surplus in the paid up equity share capital gives us the net worth. So now when you divide this net worth with the number of shares outstanding, this gives you book value per share. So this was the book value approach of valuing an equity share. The last approach under this chapter is liquidation value. Second is liquidation value. Under this approach, it is assumed that the company goes into liquidation. That is, all the assets are sold or disposed of, the liabilities are paid off, and whatever is left after that is divided by the equity shares outstanding. That gives us the liquidation value. In short, we can say sundry assets minus the sundry liabilities minus the preference shares. So this leaves us with the amount available for equity shareholders. Available for equity shareholders, and if this is divided by the number of shares outstanding, this gives us liquidation value. So this was the liquidation approach of valuing an equity share. So here we come to an end of chapter 3. The next and the fourth chapter is risk and return.